Welcome to today's version of Bob Benny Wealth Management's monthly webinar. Our topic today is understanding taxes and investment accounts. And I'm Bob Benny.
I'm Jesse Thompson. As we go through things, you might have some questions and we're going to address all of those at the end, so you can type those in at the bottom of your screen.
Okay, so we're going to first talk about investment accounts and how they are set up and how taxes are involved in them, and how it's important to choose the right type of account for the situation that you're in. There's 4 different types of accounts that we're going to be talking about. First is your employer-sponsored retirement plan, like your 401k or your 403b or your 401a, anything that starts with a 4, an employer-sponsored retirement plan that money goes in at work prior to you getting it in your check. It's your gross, and then your check is your net, and they take it out before then. And then there are traditional IRAs. That's number 2. Number 3 is Roth IRAs. And number 4, we're going to talk about taxable accounts. And we're going to talk about taxable accounts and the different types of tax consequences that occur inside of those taxable accounts.
Okay, so first we're going to go through and define what each of these accounts are and what the tax benefits are, and also what any tax limitations there might be on them for you. And then after we get done with all that, we'll compare and contrast the benefits and drawbacks of each of them and how you might want to prioritize each of them for yourself. So first we'll go through and talk about each of the retirement accounts. So the 401k, IRA, and Roth IRA. So retirement accounts have special tax statuses with the IRS that basically allows you not to have to pay any taxes on the growth in those accounts. So because of their special tax status, they come each with their own rules, which we'll go over. But basically how the taxes work on all of them are that they're either front loaded or they're back loaded. So with a Roth type of retirement account, the taxes on them are front loaded, meaning you are funding those with money that you already paid taxes on, but all of the growth, and then when you go to pay to make withdrawals out of the account, none of that is taxed. All of that is tax free. The opposite is the backloaded accounts. Those are 401ks and IRAs. In any money that you contribute to those types of accounts, you can deduct from your taxable income in the year that you contribute to them. They grow tax deferred, and then when you go to take money out of them, that's when you pay taxes on the money.
The magic number for retirement is 59.5.
So that's when you can start taking money out of your retirement accounts. That was my part, but
she skipped it maybe on purpose or not, whatever. So let's go and talk about.
But if you take an important note on that is these retirement accounts that are classified by the IRS, if you take money out of them prior to age 59.5 without having a special circumstance or exemption in those, what's allowed is outlined by the IRS. A financial advisor can help you with that. But if you take money out and don't have one of those special situations, they'll not only tax you on all of it, but you have a 10% extra penalty that you have to pay as well. So it's definitely
it's kind of the trade-off for the tax advantages of the they're called tax qualified accounts, where you get some tax advantages, but there's rules to help you try to keep the money in there. So let's first talk about 401k retirement plans and other kinds of employer-sponsored retirement plan. Most of them are what we would call traditional, and some employers have them in a Roth situation. Roth means tax-free. Most common by far is traditional, though some of the
newer companies are offering Roth. And so we'll kind of touch on, there's just going to be different rules and things like that for the Roth option. So we'll go over that as well. So I have this comparison of all the retirement accounts that we're going to go over. So as we're talking about, Roth IRAs or traditional 401ks, we'll pull that up. So your contribution to your 401k, 403b, whatever you have, is considered a salary deferral. And so it's tax deductible. So you get to lower your taxable income by whatever you contribute in that year. The amount that your employer contributes on your behalf also doesn't count as taxable income to you, and the employer also gets to deduct it on their taxes. So it's a pretty good deal for both. If you have a Roth option on your 401k, your contributions won't lower your taxable income, but you'll reap the benefits of this later when you go to take money out and you don't have to pay taxes on any of that money. So the maximum annual contribution amount in 2023 for a 401k is $22,500 is the amount that you can contribute. If you are 50 or older, you can contribute some extra money. You can contribute up to $30,000. And then the maximum amount that your employer can contribute is $43,500 on your behalf. So the total limit between you and your employer in 2023, not all employers, of course, will max that out for you, but the total limit is $66,000 or $73,500 if you're over 50. That's basically the highest amount that you can contribute to a retirement account, which makes a 401k a pretty good deal in a lot of people's situations. So note that if you choose a Roth option on your 401k, if that's something that your employer offers you, your contribution, like we said, is made with after-tax money, so you don't get a tax deduction on that. But your employer's contribution is going to go into traditional 401k. So if you have a Roth option on your 401k, you're going to have like two options on your 401k. You're going to have some of the money that's in traditional 401k, and that's your employer's contribution for you, and then your contributions will be Roth, so it will be divided.
And we can and do help people decide with their 401ks how much, whether they should put it all in Roth or put it all in traditional or mix and match, that sort of thing. We'll help you figure that kind of stuff out.
And a lot of times it depends on how much of an income deduction that you need, because if you're a high income earner, a 401k can do a lot for you to lower your taxable income burden.
You know, for instance, like right now, let's say somebody is a very high income earner, $500,000 a year, and they don't have that much saved for retirement. And so they know that when they get into retirement, they're going to have a lower taxable income. It's good to make all of their 401k contribution traditional now, but it's just different for everybody. What's the best thing to do?
Mm-hmm. And then you don't pay taxes on any earnings in your 401k until you start taking money out. Once you start taking withdrawals out of it, every penny of it's going to be taxed at your ordinary income tax rates, unless you have a portion of it that's Roth, which in that case, the Roth portion won't be taxable.
And so it's real nice. I mean, it's a neat thing, if you can, to have diversification between the tax status of your retirement money. Say some in a Roth IRA or Roth 401k type of status, tax-free status, and some of it it'd be nice if it was all in the tax-free status, but that's usually doesn't happen. But it'd be nice if you have some Roth money in case income taxes go really through the roof, so that in retirement, when taxes are high, income taxes are high, you can take some or most of your income on a tax-free basis.
So when you reach 59 and a half, if you have a 401k, you have the option to start withdrawing money out of your 401k if you leave your employer, or you can make an in-service withdrawal, or you can roll your 401k into your own IRA or Roth IRA if you have some Roth 401k.
Right.
So if you start taking withdrawals from your 401k, and you haven't rolled it over into an IRA, the 401k is obligated.
They're required by the government to automatically withhold, just like they withhold from your paycheck, automatically withhold 20% federal income taxes. And then they'll also withhold for state too. In your own IRA, when you're retired and you take withdrawals, they just withhold whatever it is you tell us, or the bank or whatever financial institution you have the money with, to withhold. Usually the 20% federal withholding rate is more withholding than people need. So it's certainly a disadvantage of of leaving your 401k with your employer when you retire and then taking distributions from it.
So another reason that you might want to roll your 401k over into an IRA as soon as you're able, even if it's before you retire, is that it's just a better option for most people. If you do this before you retire, you can keep your 401k open at your employer and continue to contribute to it. Your employer can contribute to it also, but you move the balance into your own IRA that you and or a financial advisor can manage yourself.
Because usually, like in most of the people that we talk to that come in and show us their 401ks, the investment options inside your 401k are usually kind of lame.
They're very limited,
and usually they're not the best investments, the most ideal investments for your situation, or the most ideal for performance. And so it's usually to your advantage from a performance standpoint to have it in your own 401k, where it's wide open what you invested in. It's not just limited to those whatever 5 or 10 or 20 investments that are in the 401k provider's situation.
Yep. And if you are not 59 and a half and you have a 401k and you're not sure what options that you want to choose, what allocation options from those few that they offer you, we can also help you figure out which one.
Yeah, we do that all the time.
The best out of all of those.
We'll sit down with you and help you or your family or friends. If they're still working and don't know how to invest, we can help them figure out how to and advise them. And we don't charge anything for advising people on their 401ks that we're not that aren't here.
Okay, so moving on to the next retirement account type, IRAs. So this is probably the one that most people are familiar with. Stands for individual retirement account. Individual retirement accounts are managed by you and or your financial advisor. And the greatest benefit of these, like we kind of just touched on, is the wide range of investment options that you have in an IRA. Their special tax status allows you to deduct any contributions you make in the year that you make them from your taxable income. I'll pull up our comparison here. The maximum contribution amount that you can make in 2023 is $6,500. If you're 50 or older, you can make a catch-up contribution of an extra $1,000. Special, I guess, rule about these IRAs that's pretty nice is that you can still make a contribution for a prior tax year up to tax day of the current year. So for example, if you needed to, for some reason, lower your taxable income a little bit this year for your 2022 taxes, and you hadn't made a 2022 contribution, you could make a 2022 contribution to your IRA up to tax day this year, which is what,
April 18th, I believe.
April 18th.
Normally it's April 15th. It just depends on when the 15th falls or whatever,
and that's a nice advantage because you can't do that with 401ks. Like you can't make back contributions to 401ks, but you can with both regular IRAs and Roth IRAs that we have coming up here. So everyone is allowed to contribute to an IRA, but they have special rules on whether or not you're allowed to deduct your contribution. And it depends on whether or not you're offered an employer sponsored retirement plan. Right. So if you have a 401k or 403b or something like that, they have an income limitation on whether or not you can deduct your contribution. So that income limitation in 2023 starts at $73,000 for a single person, and it's $116,000 for somebody that's married filing jointly. So if you make more money than that, you can't deduct your contribution, and an IRA might not be the best account type for you to, isn't actually, I'll just say it's just not the best account type for you to invest your extra money. You don't pay taxes on any earnings in the account while it grows. And then like a 401k, you pay taxes on all the withdrawals, every penny of it at the time that you start taking money out after 59 and a half.
So what she just explained was an IRA, which is called an IRA. We call it more often than not a traditional IRA, because there's another kind of an IRA called a Roth IRA, and that's the tax-free type of IRA. Jesse likes to call the Roth IRA the golden goose of retirement accounts, because all the money grows tax-free, and when you take it out, it's tax-free. You know, so if you had, I mean, let's say you had $1 million in a retirement account, whatever amount it is, wouldn't you rather have it be Roth IRA than traditional IRA? Because this traditional IRA money it's not all yours. It may look like it's $1 million. It may have your name on the account, but there's a future tax liability on that money. So that $1 million that's in the traditional IRA is really maybe only 700,000 of it is yours. 300,000 you're going to have to pay to the IRS over time. So that's why she calls it the golden goose. Like the traditional IRA, in a Roth IRA, you have virtually practically unlimited investment options, unlike the employer-sponsored plan. And the way that the Roth IRA works, the money that you put in there is money after you've already paid taxes on it. So you don't get the tax deduction off of your income for that year, but it grows tax-free. And they're all tax deferred until you retire and start taking money out. But Roth IRAs are tax deferred and then tax-free when you take the money out, or if you pass away and leave it to your kids, they get it tax-free too. All of it's tax-free. And that's why it's the golden goose, isn't it?
Yep. So contribution limits for Roth IRAs are the same as for traditional IRAs, $6,500 a year. Max contribution if you're 50 or older is $7,500 a year. But because of all of the tax advantages of a Roth IRA, they have a little bit more stringent rules of who's allowed to contribute. So they don't care whether or not you have an employer retirement plan. You can still have a Roth IRA and employer retirement plan, but they care how much money you make. So the income limitations for contributing to a Roth IRA in 2023 are $138,000 for a single person and $218,000 for somebody who's married filing jointly. And so if you make more money than that, they have these phase out rules and you become at risk of not being eligible to contribute, which they penalize you for, and it's kind of a bite. So if you're over those income thresholds and you contribute more than they allow you to contribute, you're penalized a 6% excise tax on your contribution to the Roth IRA every year that you keep the money in the Roth IRA. So it's kind of a big deal. So you want to really make sure that you're within the income restrictions if you're going to put money into a Roth IRA.
The final kind of a type of a category of accounts that we're going to talk about are taxable investment accounts. These are every kind of an investment account other than these retirement accounts like 401ks, 401as, 403bs, employer-sponsored plans, and then IRAs, traditional and Roth. These are not retirement accounts, considered retirement accounts by the IRS, but people use this money all the time to supplement their retirement. It's similar to a savings account that you'd invest in the stock market. That's kind of what it is. Doesn't have to be in the stock market. It can be in bonds. It can be in all kinds of other kind of things. They're usually titled as individual accounts like John Smith, or joint accounts like John and Mary Smith, or in title in the name of a trust like the Smith Family Trust. There's no contribution limits. You can put as much money as you want in there. It's all invested with after-tax money. You don't get any tax break for putting the money in there.
So the way that these accounts are taxed is that the growth is taxed. So any growth that you have in the account is taxed annually on the underlying investments in the account. If one of two things happen or both of two things happen. One, if the underlying investment pays dividends, which are profit distributions from the underlying company, or two, if you sell one of the underlying investments at a gain. And so to talk really quickly.
So if I could say one thing, it doesn't matter on what the taxes are not dependent on whether you take money out of the account or not.
Yes.
The taxes are dependent on what happens inside of the account. And you can go ahead and explain what you already said. capital gains and the dividends.
Yeah, so to go into a little bit more detail on each of those things, there's two types of dividends. And depending on how long you've held that underlying investment, that tells you how they're going to be taxed. So qualified dividends are taxed at capital gains rates. And so those are lower than most people's income rates. And for most people, capital gains rates are going to be 15%. They're 0%, 15%, or I think 20%, depending on what your income is. But most people fall within the 15% income tax bracket.
It's always going to be less than what your ordinary income tax rate is. That's why we like capital gains tax rates in comparison to ordinary income tax rates.
Yes, and you'll get those qualified dividends, that good tax rate, if you've held the underlying investment they have like a very detailed calculation that I'm not going to get into, but if you've held it for several months, you should be safe. And which is what we recommend to people. We don't like a lot of buying and selling. We never recommend a lot of buying and selling to people for these especially in these taxable investment accounts, for the reasons that we're going over right now. Now, if you are buying and selling, or say you get paid what they would call a non-qualified dividend, that type of dividend is going to be taxed at normal regular income tax rates. But if you are buying and holding an investment for a long period of time, that's not something that you have to worry about.
Not anything to worry about at all.
Now, go ahead.
So when investments inside of the account are sold, whether you take money out or not, when the investments are sold, if there's a profit, then the profit will be taxed. And it depends on how long you've owned the investment on what tax rates you get, whether it's capital gains tax rate, the lower capital gains tax rate,
15%,
or the higher ordinary income tax rate. And it's a matter of if you've held it for a year or longer. If you hold it for a year or longer and sell it, the capital gains tax rate applies. If it's less than a year, it's the ordinary income tax rate. If you sell something at a loss, you can use that loss to offset any capital gains on other investments that you sold, or other things that you sold outside of that account, like a piece of real estate. If you sold a farm and you, let's say, had $100,000 capital gain on the piece of real estate, that could be offset if you sold some investments inside your non-retirement investment account and had, say, a $50,000 capital loss. Then it's a $100,000 gain minus a $50,000 loss, so you only have to pay taxes on the $100,000 worth of gain. If you have capital losses in accounts or on the sale of real estate or whatever, if you have capital losses that exceed any other capital gains you have, then you get to deduct up to $3,000 per year against ordinary income. So let's say you sold some investments and you have a $20,000 capital loss, and you didn't have any capital gains to offset those losses or to use those losses against, then you would have you get to deduct $3,000 of that against ordinary income taxes that year, and the balance carries over. The $17,000 balance of your $20,000 gain carries over to the next year, and you can use it against the capital gains next year, or you can deduct another $3,000 against ordinary income next year. Then an advantage of these types of accounts, these taxable accounts, non-retirement accounts, is that you can do what's called tax harvesting, where you can reduce your taxable income in these accounts by selling poorly performing investments at a loss, and you can use that loss to offset capital gains. We do that often, tax harvesting towards the end of the year, like in December, looking at people's situations, seeing if that's the best thing for them to help reduce their taxable income and their capital gains income.
Now, a caution that people need to take when they're trying to do that tax harvesting and with these types of accounts is that the IRS has something called a wash sale rule. So if you try to sell something at a loss, say to offset some kind of capital gain that you have, and then you buy it back within 30 days, they'll completely void that loss and won't allow you to use it on your taxes. So that's something that you have to be aware of. And you can't even buy something that's similar to what you sold.
Well,
like you have to be very careful about
yeah,
it.
you have to be very careful. We did this with some people this year that they wanted to harvest some losses to offset other gains that they had in the year. But they wanted to stay in the market because they thought the market was going to go up. This is November, December, and the market has gone up since then. And so we sold and took and captured the tax loss, or realized what was an unrealized loss. We realized the loss, and then we invested into something that was not going to be subject to the wash sale rule, but that would go up when the market went up. Another caution in these types of accounts, this is the taxable accounts or the non-retirement accounts, is holding mutual funds in these accounts. And I'm not dogging mutual funds, but there are things that happen in mutual funds that can give you some very unwelcome surprises, particularly in years where the market's going down. When the market goes down, if you think about it, and I'm talking about these what are called managed mutual funds, when we're not an index fund, but a managed mutual fund where there's a manager or management team that is buying and selling stocks within the fund. And if they sell a stock at a gain, whether you took money out of the fund or not, you're going to get hit with that capital gain, and they'll send you a statement at the, after the year's over, that you have this much realized gains because of this sale that they did. And where you run into trouble is in years like 2022 in mutual funds, when the market's going down. Sometimes what happens is there are some people that panic and want to get out of the mutual fund. And so what the mutual fund manager or management team has to do is they got to be able to get Joe Smith his cash, because he wants to take his money out. And they normally don't have a whole ton of cash in these mutual funds. Maybe 5% is sitting in cash. And if they have withdrawals that exceed that, they have to sell stuff to give John Smith his money, and anybody else is making withdrawals from the mutual fund. And what they end up doing is selling some stocks maybe that they've owned for a long time, that even though the market's down, that stock went up and it went down, but it's way higher than what they bought it at. And so they sold a stock at a capital gain, which caused a capital gain consequence for all the shareholders, not just John Smith, but for everybody. And so what unfortunately happens sometimes, or usually, when you have a down year like 2022 or some of the other years where the whole market went down significantly, because of those withdrawals, account holders or investors that their overall account value went down, they're on their mutual fund, but they still got a tax report that said that they owed capital gains taxes, and that's a real
it's a real bite.
That's a real bite. That's just, we'll just call it a bite.
So that's part of why we use ETFs in our allocations rather than mutual funds, because they don't expose people to these kind of tax surprises that managed mutual funds do.
Right. And then there's other non-retirement account types of investments. I'm not really going to go into them right now, that people can put after-tax money in, that actually grow tax deferred, meaning you don't have to pay taxes on it as it's growing. These are called annuities. There's different kinds of annuities, fixed annuities and variable annuities. Don't think of an annuity as something that's going to pay you a lifetime payment or a payment over a period of time.
Some of them might, but
some of them
that's
might.
not the definition.
The definition, though, is that, and that's what the IRS gives an advantage to that type of an investment. You put $100,000 in there, and in 5 years it grows to $200,000. As long as you didn't take any money out, you never paid any taxes the whole time, and it keeps growing and growing and growing until you start taking the money out. When you take the money out, you have to pay taxes on the growth, just the growth. When you get down to the principal, you don't have to pay taxes on that either. But in some people's situation, that can be advantageous, and all these things have to do with each individual or family's financial situation, what's the most appropriate for them.
Yep. So we're going to go through each of the accounts that we talked about and kind of briefly summarize what the pros and cons are of each of them. And a financial advisor can help you decide which of these accounts to prioritize for yourself and your specific situation. But we're going to go through really quick here and compare all of these. So for a 401k, the advantages of a 401k is the high contribution limit. This not only can help people that need to catch up on their retirement contributions, but it can also help people lower their taxable income by a big chunk. Another advantage is an employer match, so you get free money. Some of the disadvantages are that they typically have limited investment options. And if you start withdrawing money directly from the 401k, you're going to have a 20% mandatory tax withholding.
It's not an actual 20% tax, it's a tax withholding. And so the problem with that is maybe you don't need to take that much, you're not going to owe that much tax on your 401k withdrawal for retirement. But if they're taking 20% out, you only are going to need to pay 10% on that, then you just gave the IRS money for until you do your tax return and get it back. So another type of an account, the other type of account that we were talking about is a traditional IRA. Here you have freedom and control over your investment options, unlike the limited options in a 401k. Whatever your contribution is lowers your taxable income. Disadvantage though, like compared to a 401k, it's a much lower contribution limit, and there's limitations for high earners.
Just to touch on this really quick, for a traditional IRA and Roth IRA, even though there's a disadvantage in that you have a little bit more limitation on what you can contribute on those, the power of starting those early and contributing the max to them, even though it's only $6,500, I say only, even though it's $6,500 every year, if you started and contributed that much at age 30, you'd be a millionaire by the time you turn 65. So there still is a lot of power in those retirement accounts and maxing those out if they're available to you. So
let's talk about a Roth.
Yes. So the advantages of a Roth IRA, I didn't put this on here, but you also have freedom and control over the investment options. Both growth and the future withdrawals aren't taxable. That's the major attraction of a Roth. And they also have lower contribution limits, which should have been a disadvantage. Needed to proofread that ahead of time.
Whoops.
Another disadvantage is that they have limitations for high earners, and there's no tax deduction for your contribution.
And finally, the taxable accounts that we talked about last. Obviously, there's no limitations on how much money you can put in or how much money you can take out. It's just like your money at the bank. You put in $10 million or you can put in $10, whatever you want, and take out however much you want. You have total freedom of your investment options. But the disadvantage of that is there's potential tax surprises if you don't know what you're doing, or if you don't have a financial advisor that's looking out for the tax consequences of you for you. That's one of the key things that we help people with in helping manage their accounts, as well as helping them when they're, let's say, in retirement and they need money. And that, maybe we have something set up where somebody gets $5,000 a month, like clockwork, put into their checking account on the 15th of the month. And then and this happens all the time, probably once a week. Well, so-and-so calls and they need an extra $10,000 because they're going to remodel the kitchen or something like that. I guess I wish you could remodel a kitchen for $10,000, but whatever. They need $10,000 or 20 or whatever. Then what we do is we look at the different types of investments and accounts that they have and figure out where the most advantageous place to take the money is from. And that's one of the things we do as wealth managers in helping our clients. And
another thing that we do is figure out where it's most advantageous if you have money to invest, what which of these accounts is going to be most advantageous for you to put your money into. And so just in general, hypothetically, if someone had all of these account types, they were eligible for all these account types and had them all available to them. For most people, what we would suggest that they prioritize is one, their 401k, at least up to their employer match, because again, that's free money. And then secondly, a Roth IRA, if they're eligible to contribute with their income level. And then thirdly, a taxable account with any extra long-term savings that they have. But that, of course, we've talked about all these different rules and specifications that you have to meet for all of those accounts. And so a financial advisor, we can help you figure out which one is going to be most advantageous for your particular situation.
Right. So that's the end of our webinar. The end. See you later. No, just kidding.
We're a little lengthy today.
Thank you all for coming, for attending the webinar. We appreciate everybody that's here. We do have a few questions we're going to try to answer. What is the rate of Nebraska estate tax? The Nebraska estate tax is combined with the federal estate tax, and if whoever asked this question, I can get more specific for you if you would send me an email and remind me of it, bob@bobbenny.com, and I'll get specifics and more specific into that. Another question is, if Biden gets the tax increases he wants, how does that affect our investing? Would it be wiser to get taxed now before rates go up? Biden's not going to get his tax increases. You can take that to the bank. There's a tax increase is a non-starter with the House of Representatives because the Republicans control the House right now, and I don't think that many of the Democrats that are in the House don't want to get a tax increase pinned on them either. So I wouldn't worry about income tax rates increasing. And then, are you endorsing anyone in the mayor primary, or are you following Reagan's 11th commandment? I'm actually supporting the Suzanne that's running, and but the other guy is good too, Stan, and I guess I could say that. But anyway. But anyway, we're really glad you attended. If you have any further questions, please give us a call at 421-2626 or email Jesse or I. I'm bob@bobbenny.com.
I'm Jesse@bobbenny.com, and we meet with people. If you have friends or family that need help, we meet with people and help them with all this stuff that we talked about today, help them figure out where they should invest their money, where they need to take withdrawals from, things like that. We do that for free for people. When we do consultations with people or anything like that, we don't charge for that. And so if you have anybody that needs help, feel free to send them our way.
Thank you very much and have a blessed day.